The next paper is being presented by Yannick Schindler, and it's on bad banks, bad luck, evidence from 1 million firm bank relationships.
Thank you very much to the organizers for having me. It's a pleasure and privilege to be here today, and it's a wonderful conference so far. This is joint work with my colleague and friend Peter Lambert at Warwick and the London School of Economics. And what we try to do in this paper is we study the effects that bank failures have on firm-level outcomes, with a particular focus on the very smallest businesses in the economy. Now, I think with the present audience, I probably don't have to motivate this topic all too much. Suffice it to say, there we go, sorry. That bank failures are not like a vanishingly rare event in the US, unfortunately. There have been about 3,000 bank failures since 1980. Unfortunately, again, they disproportionately affect smaller regional community banks, but of course we sometimes also get these really large, high-profile bank failures, as was the case 2 years ago with Silicon Valley Bank and First Republic. So this is just a timeline of when these bank failures happen, where the size of the bar is the size of the bank measured by assets. Now, these events do draw a lot of media attention, as we just found out. And yet I was surprised to find that actually, when you go to the literature, we know surprisingly little about how these events affect the very smallest business in the economy. And that's particularly concerning because we know that small businesses are very reliant on bank lending for getting credit, so they can't issue bonds, they can't go to equity markets. They could, of course, rely on things like credit cards, but they really do rely on banks for getting credit. And furthermore, they tend to really only have one relationship with a bank. They don't really diversify their relationship portfolio when it comes to banks. And so they seem particularly exposed to their lender failing. The reason for why this particular question has been difficult today to study is because in the US there has traditionally been, it's been very difficult to have very comprehensive and large-scale data on the business bank relationships for these very small businesses. So of course there are some data sets that tell us who banks with whom, so you could go to like syndicated loan data, there's some supervisory data, but when you use these data, you're generally looking at firms that have at least a couple dozen, if not hundreds or so employees. Just to give you a notion for the size of firm that we study in this paper, the median firm size here is 3 employees. So there's a really very small microenterprise. What I want you to have in mind is like, I don't know, a mechanic or a laundromat, a very small restaurant. We overcome this data challenge by collecting 36 million loan documents that span about 2 decades, so from 2000 to present day. We use these loan documents to build a data set of 1.5 million unique businesses linked to 4,000 unique banks. The firm level information about these firms is going to come from a commercial data provider called Dun & Bradstreet, and the bank level financial information we get either from call reports or, again, a commercial data provider called Orbis. Now, we bring in some other data as well. So we've recently been working on getting branch level information in. So for example, around each of the 1.5 million businesses that we have, we draw a 10-mile radius and then bring in all of the branch locations of branches that are nearby to these businesses. And so, of course, we have this really rich data set now to study many questions related to small business lending. But the first thing that we set out to study was how bank failure affects the performance of these firms. In particular, we look at 3 dimensions: firm survival, employment, and revenues. And we can exploit over 200 different bank failures that are covered by our data set to do so. Just to give you a preview of the results, small firms who bank with banks that fail are significantly more likely to cease operating in the years after the bank failure relative to peer firms who are very similar. Those firms who survive after the bank failure or after being exposed to bank failure also show significantly lower employment growth and lower revenue growth. And we also document that there's very large variation in the harms of bank failure to small businesses across the different bank failure events that we study. So some bank failures have historically been much more harmful to small business borrowers than others, with a very small fraction of bank failures actually showing in our data to have had a positive effect. Now, of course, I think generally when I present this, I have to pause here a bit. I think the present audience is probably more familiar with how bank failure operates than other audiences. But I want to stop here and to just say, like, ex ante, these results weren't, I wasn't sure what to expect when we started this research program. Because, of course, a bank failure isn't the kind of situation where you show up on a Monday and then the bank is closed and it just says, you know, I don't know, good luck, we don't know what will happen with your deposits, and have fun. Yeah, we don't know what will happen with your loan, and yeah, bank is closed now, but rather it's a highly regulated event, right? As Stefan showed us, there's going to be basically a press release that goes out Friday night after markets have closed at the end of the business day that says, Bank XYZ unfortunately has closed. Of course, deposits are insured. Oh, and by the way, we've already been working behind the scenes to find an acquirer of this struggling bank. So don't worry, online banking will continue to work. Checks will continue to clear, and on Monday you can still go see Bob or whoever it was who was the loan officer who handles your business account or your business credit line. And so against that backdrop, it's not even clear that going through that sort of regulatory event as a small business borrower would be bad for you. I mean, if anything, it could be a good thing. By definition, you're basically having your relationship moved from a struggling bank or a poorly capitalized bank to a well-capitalized bank. But the results show that, yeah, these bank failure events are quite detrimental to these small business borrowers. Now, because these results are based on very new data, I just want to spend a couple minutes talking about how we put this together. The 36 million loan documents that we collected are called UCC financing statements. Here's just one example. This is a UCC financing statement for a very small coffee shop in LA. The key thing to note here is that these documents get filed with the Secretary of State offices in each state. Importantly, they tell us the name and address of the business that is taking a secured type of credit, either a credit line or a secured loan from a bank, and it tells us who the bank is that is providing this loan. Now, banks like filing these whenever they extend secured credit to a business because it's a public record. It prevents that business from then going to the next bank and saying, oh, by the way, I'd like to take my business assets and get another secured credit line, so it prevents recollateralization. And it also gives lenders a bit of recourse in the event of non-payment to have this piece of document to say, well, you haven't paid, so we can now claim against your business assets. In terms of geographic coverage, we obtained these documents from 6 different Secretary of State. So this is California, Colorado, Texas, Illinois, Florida, and the state of New York. But because very often someone will file in a particular state for a business that operates in another state, we do have coverage for virtually all counties within the United States. Now, once we've put together our data set, I'll spare you the detailed econometrics, but what we're doing is we're looking at firms whose bank we know fails and comparing their outcomes in terms of firm survival, firm employment, and firm revenues going forward for 10 years, and comparing those to firms whose bank did not fail, controlling for a lot of both bank and firm covariates. So what I want you to have in your mind is that we're basically comparing 2 firms that are of the same age, the same size, operating in the same location, operating in the same industry, banking with a bank of a similar size in a given year. One of these firms is going to go through a bank failure, is going to experience their bank failing, the other not, and then we trace out the differential trajectory of these 2 firms going forward. The results of that exercise are here. The way to read this is that on the x-axis I have event time relative to the bank failure event. On the y-axis is the effect size in percentage points. So the way to read it is if you look at sort of event time 5, that's saying that after 5 years after the bank failure, a business or small business that had a relationship with this bank at the time of failure is about 7 percentage points less likely to still be operating relative to very similar firms that did not experience this bank failure. We can also go and do this analysis going backwards, so prior to the bank failure, just to convince ourselves that this differential evolution in the survival rates of these firms, or the picture looks exactly the same if I do employment or revenues, but to convince ourselves that these effects really start at the point in time of the bank failure, not before. We can also take the event time backwards, and we see that when we look prior to the bank failure, we don't yet see any of this divergent survival rates, employment growth, or revenue growth, convincing us that yes, most likely this can be attributed to the bank failure event itself. I also want to point out that there's this persistence, right? So with survival, it's a bit weird to think about because obviously once the business has died, it can't come back. But for example, if we think about revenues or employment, it's not that upon bank failure exposure, so my bank fails, I just sort of slow down hiring or I slow revenue growth while I get a new bank relationship, and then once I'm banking with a new bank, I have this catch-up growth. No, this picture would look the same with employment and revenue, in that the bank failure event seems to have these long-term scarring effects on the firm's viability, even going forward, and are statistically still being detected a decade after the bank failure event. Now you may still be worried, okay, but maybe like right in the lead up to the bank failure, the bank is sort of throwing Hail Marys and just trying to lend to everyone, and so all that this analysis is picking up is that right before the bank failure happens, that bank is really basically taking loads of lending risks, and so you're just seeing selection effectively that this bank is about to fail is extending credit to just much worse firms than would otherwise be the case. To address that particular concern, we leverage a particularly interesting case that happened during the financial crisis, where the FDIC was forced to close a bank that was relatively well capitalized. So going into the financial crisis, there existed a bank holding group called FBOP. There were 9 banks that belonged to this bank holding group. They were operating predominantly in California and Arizona, so sort of the US Southwest. The largest of those were operating in California. They were Pacific National, San Diego National, and California National. And this picture that I'm showing you here shows the trajectory of these banks as they're going into the financial crisis in terms of their capitalization ratio. And you can see that, for example, California National went from being well capitalized to basically having zero equity left, or having a capital ratio of 0. Similar very steep declines for both Pacific and San Diego, so that by September 2009, the FDIC is saying we need to close those banks. They've become non-viable, and we're going to make use of a very unique power that the FDIC has, which is called the cross-guarantee power, which allows it to make other banks in the same bank holding group responsible for the losses that failed banks are causing to the FDIC insurance fund. Now, very unfortunately for Park National, which was a very small bank, around 120 million in assets, which is operating a couple of branches in Illinois, it belonged to this bank holding group, was effectively delivered one Friday evening, or maybe they waited until the weekend, basically a demand for payment, more or less, from the FDIC to cover its sister banks that had failed, and immediately became insolvent because, of course, it was swamped by this liability, and the FDIC closed that bank. So in that case, we can argue that at least for Park National, the closure of that bank, which at that point was still adequately capitalized, at least according to this taxonomy of capital ratios, it was arguably a bit more exogenous than just any old bank failure. And when we run our analysis just doing Park National, we still get that this had an effect on small business borrowers. I want to also highlight that the effects of bank failure on small business are really concentrated amongst the very smallest businesses out there. This is plotting the effect averaged across 5 years post-bank failure for different firm size categories. Again, on the y-axis, you have the size effect in percentage points on firm survival. And we note that even when you have businesses that have 6 or more employees, the effect is basically nil. but that for very small businesses that only have 1 or 2 or 3 employees, the effect is really quite large. And again, this highlights that if you were to look at some of these existing data sets where you have businesses with many dozens of employees, you would have never seen this particular effect because it really is concentrated among the very most vulnerable and smallest businesses out there. The last thing I want to say as I wrap up is that when we do our analysis for each individual bank failure individually, and there's no need to sort of turn your head and try to read the x-axis here. The point is really the picture that shows you, sorted by size of effect, the effect of that particular bank failure on small business survival, that there's really a lot of dispersion there. Some bank failures really were much more harmful to the small business borrowers than others, and on the right-hand side we do pick up a couple of bank failures where it did appear to be a good thing for those business borrowers that their struggling bank was acquired by a better capitalized bank as forced by the FDIC. We've thrown quite a lot of things at this trying to explain this gradient in effect size, because obviously the burning question now is, well, tell us what makes a bank failure be in the far left and what makes a bank failure be in the far right so that we can get more from the far right. And that's currently work in progress, so stay tuned. Just as I conclude, if there's one thing you should be taking away is that, these bank failures, even though on paper they really do look quite frictionless, the FDIC does a great job of finding acquirers for struggling banks, and the process is relatively frictionless for these small business borrowers whose bank fails. There do seem to be these really detrimental effects to the very smallest businesses that experience this. The effects are substantial, long-lasting, and there's large variation across banks. It's new data. I'm very excited about it. I'm going to just shamelessly plug the work a bit more. If you have any research ideas or you find this data interesting, please find me or reach out. I'd love to do much more work with these data, because now I've invested the fixed cost and poured my sweat and tears into this. So do find me if you have ideas with what sort of things you wish to have studied with these data. Thank you very much.
Thank you. Thank you, Yannick.